I'd like to talk a little bit about liquidity as regards to the Delaware Statutory Trusts. This is from one of their brochures. It says, the leasing of high-quality commercial real estate is generally designed with the objective of providing investors with a recurring stream of income. And that's really what a lot of the people that they're targeting want. They're people that have owned income property. The problem is that what's most important is total returns, as well as how much risk you're taking in order to get a particular return. So if you have very anemic returns and you're getting sort of an income stream, but if your total returns at the end are not as good as you could have gone somewhere else, you could always just gone somewhere else and sold off part of your assets to get the capital gains, and you still end up with more because your total returns would be higher. Regarding non-traded REITs or DSTs, the rents collected and the increased property values are both part of the total return. But then remember this page? And we saw that on several of these, the program acquisition price is higher than the property sales price because of all these front-end loads. And so what it actually cost, the investors are actually paying more for these properties than they are worth at the beginning. So you have to appreciate quite a bit in order to actually make profit on the sale. Also remember that the capital appreciation only happens when the vehicle ends, the DST. And at that time, you've got more back-end fees, and then you have another front-end load if you want to roll it into another DST. If you don't want to roll it into another DST, then you're going to pay your capital gains, which is the whole reason that you were getting into this in the first place, was because of that 1031 exchange. Here's another one from the private placement memorandum. There is no public market for the interests. If you don't like it, you can't just go out and trade it. In general, a purchase of interest is irrevocable and may not be canceled, terminated, or revoked. You're in it for the long haul. Investors may not realize a return on their investment for years, if at all. Maybe they usually do. But how much risk are you taking in order to get a certain reward? Right? If you want a steady stream of income, well, 10-year government bonds are paying about 2.5% right now. On those, that's pretty much a sure thing. Let's see. Remember, with the DSTs, your money will be tied up for anywhere, usually in the range of 3 to 10 years. Sometimes a little more, sometimes a little less. On this page that I was looking at before that I showed you, had average of about 7.3 years. An investor should expect to have taxable income even in the absence of any distribution of cash. It is expected that an investor's interests will generate annual taxable income in excess of the cash distributable to such investor. So if you're counting on a big payoff at the end when they sell the properties, because as I said, I think this much of the profits that are potential in this is really due to market speculation on real estate. But you have to have enough cash to get by in the meantime, because what you get on your returns, you might actually be taxed on a higher amount of income than what your cash distributions actually warrant. Investors will be entitled, based on their respective interests, to monthly cash distributions. Great. Net of, this is after, amounts required to pay and reimburse the parent trustees, pay debt service on the loans, and ordinary current and future expenses. And we talked about some of these expenses too. But this is your regular income stream. How much is it? I don't know. based on the profits that I was calculating in a previous video, it seems like it's not really that great relative to how risky this investment is. And that's really what it's all about. It's not can you get a high return, it's how much risk are you taking. And I think that this one, you're taking a lot of risk for potentially high returns. If you happen to get one of those 5% of those Delaware trusts that they actually sell and get a good, maybe they can turn it over in 2 years at a high profit, then you might get a good return. But if you're stuck for 10 years in one of the dogs and you're 70 years old right now, that's not going to help you. Okay? So I think that'll be just about it for right now. Okay? Thanks.